You are about to hand over a $16,500 gift to the ATO without even knowing it. And the worst part? It is completely avoidable if you act before the clock strikes midnight on the 30th of June. If you are over 45 with a balance exceeding $300,000 in a fund like Australian Super or ART, you are currently standing in a compliance minefield. Welcome to Aussie Super Secrets. Today, I am going to reveal the exact tactical sequence to secure a $12,450 tax saving before you file your next return, while dodging the administrative traps that trigger brutal ATO penalties. At the end of this briefing, I will reveal a hidden admin fee cap that most retail funds never mention, which could be costing you thousands in silent leakages. You cannot afford to miss this. But before we dive into the technical math, we must address the legalities. This video contains general information only and does not constitute personal financial, taxation, or legal advice. You should seek independent advice from a qualified professional, such as a licensed financial advisor or accountant, before making any investment decisions. Now, let's look at the new landscape for the 2025 to 26 financial year. The concessional contribution cap has moved to $30,000. This is your golden ticket to tax minimization. If you are in the top marginal tax bracket, earning over $190,000, you are being slugged 45% tax plus the Medicare levy on every extra dollar you earn. By shifting that money into your super through salary sacrifice or personal deductible contributions, you effectively slash the tax rate down to just 15%. That is a massive 30% spread staying in your pocket instead of the government's coffers. But here is where the $16,500 nightmare begins. Most high-income earners think they can just transfer the cash and forget about it. Wrong. If you make a personal contribution and fail to lodge a notice of intent to claim a tax deduction with your fund before you lodge your tax return, the ATO will flatly deny your deduction. You lose the tax break, and in some cases of repeated non-compliance or exceeding caps without rectification, the cumulative interest and penalties can spiral toward that $16,500 mark. But do you know the absolute worst thing the ATO can do to your retirement timeline? We will see that in a second. Because timing is everything. Hablamos de the BPAY death trap. Many of you will wait until the 29th of June to hit send on your banking app. This is financial suicide. Under Australian law, a contribution is only counted in the financial year it is received by the fund, not when you sent it. BPAY and EFT transfers frequently take 3 to 5 business days to clear through the banking system. If your $50,000 catch-up payment arrives on the 1st of July, it counts toward next year's cap. You lose the deduction for this year, your taxable income stays inflated, and you could face a tax bill that is $12,000 higher than you planned. You must ensure your funds are cleared and visible in your industry or retail fund account by the 25th of June to be safe. Are you making the most of the carry-forward rules? This is the most powerful tool for anyone with a Total Superannuation Balance, or TSB, under $500,000. If your balance was below that threshold on the 30th of June last year, you can reach back and use the unused portions of your concessional caps from the last 5 years. For a high flyer who hasn't been maximizing their super, this could mean a single deduction of over $100,000 in one go. Imagine the impact on your tax return when you wipe $100,000 off your taxable income. That is the difference between a massive bill and a legendary refund. But wait, there is a shark in the water for anyone earning over $250,000. It is called Division 293 tax. If your combined income and super contributions cross that threshold, the ATO hits you with an extra 15% tax on your contributions. It essentially doubles your super tax rate from 15 to 30%, while it's still better than the 45% marginal rate. Many executives fail to set aside the cash to pay this separate assessment, which arrives months after their standard tax return. But what if I told you that your choice of investment option within your fund is actually working against you? We will get to that choice vs my super trap in just a moment. First, another vital reminder for your protection. This is general information only and does not constitute personal financial, taxation, or legal advice. Always consult with a qualified professional before implementing these strategies, to ensure they align with your specific circumstances. Now, let's look at your fund structure. Most Australians are dumped into a My Super default option. For a high net worth individual with $500,000 or more, these default options often have percentage-based administration fees that never stop growing. You should be investigating choice or member direct options within your fund. Many industry funds offer a fee cap on administration costs. Once you hit a certain balance, if your fund caps admin fees at $600 a year but you are currently paying 0.2%, on $1 million balance, you are effectively throwing $2,000 a year into the bin. Over 10 years. That is $20,000 of lost compounding growth just because you didn't check a box. Let's talk about Sarah. Sarah is 52 and earns $220,000 a year. She had a TSB of $480,000 last year. She decided to use $60,000 of her catch-up concessional contributions this June, because she is in the 45% tax bracket. That $60,000 contribution saved her $27,000 in personal income tax, even after the fund paid the 15% contributions tax. She still came out $18,000 ahead in net wealth. That is the power of a proactive EOFY strategy. But what is the final high-impact revelation I promised? It's the indexation trap. On the 1st of July each year, the transfer balance cap and other thresholds can change due to indexation. If you are planning to move a large sum into a tax-free retirement phase soon, the timing of your contributions this June can affect your eligibility for certain offsets next year. Every dollar you put in now is not just a tax saving today, it is a protected asset against the future Medicare levy and bracket creep. The ATO is watching compliance closer than ever in 2026. They are cross-referencing single-touch payroll data with fund receipts in real time. If your salary sacrifice agreement isn't documented correctly, they will treat those contributions as non-concessional, meaning no tax deduction for you. Make sure your payroll department has the paperwork signed before the next pay cycle starts. If you found this briefing valuable and it saved you from a potential $16,500 headache, make sure you subscribe to Aussie Super Secrets and hit that notification bell. We are here to ensure you keep more of your hard-earned wealth. And give the ATO as little as legally possible. Don't let them win by default. Tune in this coming Thursday at 7 p.m. sharp for our next episode, where we will expose the hidden insurance premiums that are quietly draining 60-year-old super balances by tens of thousands of dollars. You might be paying for cover you can no longer even claim on. Subscribe now and I will see you in the next one. Stay wealthy. Disclaimer: the information provided in this video is for general educational purposes only and does not constitute financial, taxation, or legal advice. It has been prepared without taking into account your personal objectives, financial situation, or needs. Before acting on any information, you should consider its appropriateness and consult with a licensed professional, such as a financial planner or tax agent. Specific results or future performance are not guaranteed. Copyright symbol 2026 Aussie Super Secrets. All rights reserved.